In this video, we will explore the terminology in the equity market. We are going to look at a comprehensive guide to valuation, earnings, and market ratios so you can understand the financial world better. Let us start with face value. This is essentially the nominal price of a share. To calculate the equity share capital, we multiply the number of shares issued by this face value. For instance, if a company has issued 1 lakh shares with a face value of 10 rupees, then the equity share capital is 10 lakh rupees, that is 1 lakh multiplied by 10. Usually, this value stays constant unless a corporate action happens like a stock split. If you hold one share worth 10 rupees and the company splits it into 5 shares, the new face value becomes 2 rupees. You now hold 5 shares, but the total value remains the same. Next, we need to distinguish between book value and market value. Think of book value as the accountant's view. It is the net worth, which is capital plus reserves, divided by the number of outstanding shares. It represents the theoretical cash you would get per share if the company wound up today. On the other hand, market value is the investor's view. It is simply the current price of a share in the stock market, driven by expectations and sentiment. While book value is calculated using the balance sheet, market value is the market price per share multiplied by total outstanding shares, which gives us the market capitalization. Moving on, let us look at replacement value and intrinsic value. Replacement value is what it would cost to set up a brand new company today with the exact same infrastructure and plants as an existing firm. Intrinsic value is a bit more theoretical. As Warren Buffett says, it is the discounted value of the cash that can be taken out of a business during its remaining life. Essentially, we look at all the future cash flows the company will generate and calculate their present value today using a discount rate that accounts for risk. Now, how do market value and intrinsic value relate? If the estimated intrinsic value is higher than the current market price, the stock is considered undervalued, which is a signal to buy. Conversely, if the intrinsic value is lower than the market price, it is overvalued and you might want to sell. This is why investing is considered both an art and a science. The science part involves the mathematical formulation of financials. The art lies in the qualitative assessment of management and future potential, keeping in mind that markets are driven by complex human behavior. Let us deepen our understanding of market capitalization or market cap. This is the collective value placed by market players on the entire company. We calculate this by multiplying the market price per share by the total outstanding shares. Stocks are often categorized by this size. At the top, we have large cap stocks, which are usually the top 50 to 100 companies with stable profits and high liquidity. Below them are mid cap stocks, followed by small cap stocks which have lower liquidity. We also use the market cap to GDP ratio as a macro indicator to measure the size of the stock market relative to the economy. A crucial concept for valuation is enterprise value or EV. This represents the overall value of the business, focusing strictly on capital gainfully employed. To calculate it, we start with the market value of equity and add non-controlling interest, preferred capital, and debt. Then we essentially subtract the cash and cash equivalents and non-operating investments. Think of this as the theoretical price tag to take over the entire company, paying off debt but keeping the cash it already has. Let us look at a practical calculation example to make this clear. Suppose a company has 10 lakh common equity shares trading at 340 rupees. It also has preferred capital of 8.5 crores, debt of 6.4 crores, cash reserves of 2.5 crores, and financial investments of 1.4 crores. First, we calculate market cap, which is 340 multiplied by 10 lakhs, giving us 34 crores. Then to find the enterprise value, we take 34 plus 8.5 plus 6.4 minus 2.5 minus 1.4. This gives us a final enterprise value of 45.0 crores. Now, let's talk about earnings and earnings per share or EPS. You can visualize earnings as a funnel. At the top, we have EBITDA, which is earnings before interest, tax, depreciation and amortization. Below that is EBIT, where we have accounted for depreciation. Finally, at the bottom, we have net profits, which is what is available to equity owners. To find the EPS, we divide the net profit by the weighted average outstanding shares. For example, if the net profit is 10 lakh rupees and there are 2 lakh shares, the EPS is 5 rupees. Remember, a higher EPS generally indicates higher profitability. Another return for shareholders is the dividend per share or DPS. This is the portion of profit distributed to shareholders. It is very important to remember that dividends are declared as a percentage of the face value, not the market price. So, if the face value is 10 rupees and the dividend declared is 40%, the calculation is 10 multiplied by 40%, which equals 4 rupees per share. We can also calculate the payout ratio by dividing the dividend per share by the earnings per share. One of the most common valuation metrics is the price to earnings ratio or PE ratio. This measures the price the market is willing to pay for every 1 rupee of earnings. The formula is simply the market price per share divided by the earnings per share. If a stock has a PE of 12x, it means it trades at 12 times its earnings. We look at trailing PE based on historical earnings and forward PE based on future estimates. A high PE usually suggests growth is expected or the stock is overvalued, while a low PE might indicate a correction phase or a value buy opportunity. Sometimes earnings are not the best metric, especially for loss-making companies. In that case, we use the price to sales ratio or PS ratio. This measures the price investors pay for each rupee of sales. Let us try a calculation. Imagine a company has sales of 1 crore rupees, 10 lakh shares and a share price of 40 rupees. First, the sales per share is 1 crore divided by 10 lakhs, which equals 10 rupees. The PS ratio is then 40 divided by 10, which equals 4. This ratio is best used for companies with negative profits where the PE ratio is meaningless, but be aware it is highly sensitive to drops in revenue. Next is the price to book value ratio or PBV. This compares the current market price to the book value per share. Consider a company where the net worth, meaning capital plus reserves, is 60 lakh rupees and there are 6 lakh shares. This gives a book value of 10 rupees. If the current market price is 20 rupees, the PBV is 20 divided by 10, which equals 2x. If this ratio is less than 1, the stock is potentially undervalued. This metric is particularly relevant for the banking and financial sectors where assets are marked to market. Finally, we will look at differential voting rights or DVRs. These are shares similar to normal equity, but they come with fewer voting rights. In this arrangement, the investor gives up voting power or control. In exchange, the investor usually gains higher dividends and can buy the shares at a discounted price. According to the Companies Act 2013, a company must have a dividend history of at least 10% over the preceding 3 years to issue these. Well-known examples in India include companies like Tata Motors and Pantaloons.